So a number of things have worked really well this year. Most obviously, technology has done really well. So we have quite big positions in all of the funds except for the income fund in technology. And that's done well, obviously, on the AI boom. One of the specialist ideas we had, which has done really well, is our holding an aircraft leasing company. This company owns A380s and leases them to Emirates. Those leases are now coming to an end, and Emirates has just bought these aircraft back from the company, and we've done really well from that. What we realized was that because of all Boeing's issues, basically Emirates was expecting some new aircraft from Boeing, the 777X. This has been delayed, and because of that, they've had to come and buy the aircraft off our trust at a higher value than the market expected. It's been a really nice idea for us, and it's worked really well. We've also got a similar trust, which is expected to wind up at the end of next year, which is also in the funds. So that's another idea we've got for next year. We think, again, that Emirates is going to need to come and buy those aircraft because of Boeing's issues. Some of the other really exciting ideas we've got are some of our alternative income trusts. These have been very unloved by the market as rates have gone up. In many cases, a lot of them have halved. But we're now getting what we think are very safe, stable, very high yielding dividends, often 8, 9, 10% in some cases for critical infrastructure, things like GP surgeries or supermarkets, where we think we can get a really stable, good income. And these trusts are now trading on huge discounts to their net asset value. So we're quite excited about those longer term. We're quite happy to be patient and collect dividends. So there haven't really been any dramatic position changes this year. Last year, we upped our investment trust weight significantly as the higher rate environment caused a lot of these things to sell off and presented a lot of ideas. This year, we've been slowly building our weight in these positions and at these big discounts. And it's more of a case, we think now, of just being patient and waiting for things to play out. We hope that inflation is now under control and that interest rates are going to come down a bit. And we think that it should be very positive for a lot of these names which we hold. Even if that's not the case, though, many of them are now yielding so much and are on such big discounts that we think they're very good value in almost any scenario. We've had many debates amongst the team this year. There's been loads of things to talk about. Some of them, AI has obviously been a huge debate, and the tech valuations in the US. Is AI overhyped or is it a real game changer? So that's been one debate. Another big debate we've had is China. China is looking very cheap, but arguably it's cheap for a reason. China has a lot of big challenges at the moment, and we've sort of been debating India versus China. We really like the outlook for India longer term, but it's also a significantly much more expensive market than China. So there's been a big debate about changing those weights and things. At the moment, we're probably slightly more in the India camp, just on that long-term view. Although it's expensive, we really believe India has a huge growth runway ahead of it. So those are the two main debates we've had probably. So we've been delighted with the amount of income which the income fund is generating at the moment. We increased the monthly distribution at the beginning of this year again, and we paid out a record final distribution at the fund's year end. So the income coming into the fund is really good. And we're really excited about the things we're buying at the moment on some very high dividend yields, which we're hopefully locking in for the long term. And we hope that these dividends can grow in the future as well. So we're quite excited about the outlook for dividends going forward.